question number 4. Which of the following is not required disclosure? So this is a theoretical question, IFRS 7. Laila will see. Here, middle. So basically, I want all of you to write down what is it wrong, what is it correct, and all that. So your final exam will be, in terms of difficulty, will be the same. So I don't want to, at least I don't want to see you all failing the internal exam. That's my baseline. But in my heart, I know already many of you in the class can actually score very well. Yeah. So yeah, it worth the effort to push you a bit up. But at least I don't want to see you again repeating this internal paper. Okay. So the difficulties of the final exam will be about the same. But the question will be more, but not so many computation questions. Okay. Then we will continue now. Alright, so we want to know which one is not the required disclosure under IFRS 7 if we are looking at financial asset, fair value through profit or loss. Okay, so if we have a financial asset, which is financial instrument topic, module 6, FVPL, right, we have to disclose credit risk. You just imagine like your trade receivable lah. Trade receivable is one of the examples, right? Trade receivable is one of the example of financial asset. This is in module 6, IFRS 9. You have to disclose the maximum exposure to credit risk. You have to do the provision for a credit loss, right? And then you have to disclose the change in fair value because of the change in credit risk. Maybe stage 1 to stage 2 or stage 2 to stage 3 if you have read and you remember. And then you have to disclose the change in fair value of derivative mitigating the credit risk exposure, and therefore the answer is C. I mean, we are choosing the wrong answer, so the wrong answer is C. Okay, so basically we don't have to disclose the change in fair value of the financial asset due to the change in market condition. How are you going to convince yourself? What is the example? Now the example is investment in equity instrument. Investment in equity instrument. So basically, right, investment in equity instrument is one of the example of financial asset. The story I always told you, we are a company, and then our company purchase Maybank shares. So when you purchase Maybank shares, you will credit cash, and then you will debit investment in equity instrument, which is a financial asset actually. And then we will normally do fair value through profit or loss unless you are making an irrevocable election to recognize, to classify the accounting treatment as fair value through OCI. Okay? Now, and you will know that Maybank share fluctuates so many times every day. Takkan like you disclose the market condition like 1,000 pages, right? It doesn't make sense, right? That's why it is not a disclosure requirement. So the answer is wrong. It is not a requirement for you to disclose the fair value of the changes in fair value of financial asset like investment in equity instrument because of the change in market condition. It is not an tedious or detail. Okay, otherwise like 1,000 pages is not enough. Then we will look at question 5. Which one is a primary financial instrument? Okay, we have primary instrument and secondary instrument, right? So the secondary instrument is actually all sort of derivative lah. So the derivative could be, we only have 4 types, right? So we have share option, we have swap, we have forward, and we have, what is it? One more. And then another one is, what is it? One more. Also start from F, is it? Forward, Sorry?
Future.
Future. Start with F. Future. So primary financial instrument apparently is ordinary shares lah. All the financial assets, all the financial liability, all the the shares, they are primary financial instrument. Okay, then we will look at so question 1 to 4 are C, answer are C, and then 5 the answer is D, and And then for question 6, the answer is A. Okay, in accordance with number 6, in accordance with IS 28, investment associate, which one of the following is not an indicator that investor has significant influence over an investee? So we are looking at the theory, significant influence. We have the power to influence the policy making decision and blah 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 blah, right? So we can participate in policy decision. We can provide essential technical information. We represent the board of directors of the investee, and we exchanging factory workers only is not demonstrating the power to participate. Exchanging key management, yes, this one worker only to go. Okay, if exchanging key management like your executive director, exchange, okay. So the wrong answer is A. We are choosing the wrong answer, so the wrong answer is A. Now, after that, question 7 onwards, we are going to look at computation question. These are all multiple choice questions. However, I change it. I want to see your answer, and I don't want to see I don't want to see like if you temper it correctly and all that. I'm not able to detect whether you got it correct or not based on your understanding. So I strongly encourage you, you have your answer now, you have the question now, you write whatever you want, if it is wrong, if it's correct, and you can pick up faster instead of studying it slowly on your own. And very obvious, many students, you only manage to study like half of the 3 modules. Some can do like module 5, then memang cannot do module 6, you know, and things like that. So you have to remember, you have to pass all your modules in an extra exam. For internal exam, total 40 marks, then you can pass already, including the test and everything. Okay, so we will start now looking at question 7, module 5 question. Alright, so this is a group account question. How do we know? Because there is a parent here. Okay, now there is a parent here, and then I want to look at the last sentence because I want to know what is the requirement. Okay, the requirement is I have to prepare a console worksheet, and then I have to prepare a console entries. Journal entries will be processed in the consolidation worksheet is actually referring to console entries. That means all your pro forma entries no marks. So CPA financial reporting exam, normally they ask you console entries only. Your parents entries, subsidiary entries normally not unless you have to fill in the blank in the dashboard. So tiny sold inventory to the parent monster. So will our answer be different if it is the other way around? Answer is no. Our answer will be the same no matter subsea sold to parent or parent sold to subsea. Okay. Now and then the parent used the inventory as a plant. And Tiny purchased inventory for 47,000 and sold the monster for 69,000. Tax rate is 30%. Now listen carefully. I want you to read like this. If it is a group account question, you read like that. Tiny sold 47,000 worth of inventory to monster at 69,000. So Tiny sold 47,000 for 69,000. Tiny has made a gross profit of 32,000, is it? So Tiny has made a gross profit of 22,000. But this gross profit, net of tax, you multiply by 0.7, it is 15,400. It will not be realized if it is not sold to the third party. So basically you read it as 47,000, sold it at 69,000, and therefore there is a profit of 22,000. Can or not? So it's gross profit lah. So you just take the difference. I bought it at 47,000, I sold it at 69,000, I have a gross profit of 22,000, right? However, we always do net of tax, right? So you can you can multiply 30%, you get 6,006, right? And then you use 22,000 minus 6,006. If not, you can do faster. 1 minus 30% is 70%. So you use 22,000 times 0.7, you will get 15.4 thousand profit net of tax, or the so-called net profit. Okay, this is net of tax. Net profit is okay if the parents sold everything to external parties. However, if they have not sold to the external party, we will consider this as unrealized profit. So we will look at the question. Now, because this is the last day, almost the last day of the year already. Okay, so it is actually not sold, and some more, probably there's no intention to sell because the parent take it as a plant. So normally plant they will use for many years, right? So almost the last day of the year, and also this is taken as a plant. So probably it's not going to be sold, and probably the company will have to figure out about the depreciation and a lot of headache in the future. Alright? So now we know this is unrealized. Profit normal balance is credit side. Now when it is unrealized, there is a tax effect temporarily. So we have to reduce the 30%, which is 6,006 just now. 22,000, 70% is net profit, right? Net of tax, right? Then the 30% of the tax effect, 22,000 times 30%, which is 6,006, will be the tax effect. So you try to think whether I should debit or credit or not. Now, profit, the normal balance is credit. Gross amount is 22,000. I want to reduce the 30% tax effect, and therefore I do the value of the normal balance, which is a debit, because profit is credit side, right? So I want to debit 30% out. So this one times 30% is 6,006. So I want to debit, and therefore I debit and accept. So I name it as a DTA. So now no time already, you can memorize like that. So whenever there is an unrealized profit, you will actually have a DTA at console level, not individual level. So for sure, this thing will be done at console level. Why this is important? Because only if you know it is at console level, then only you know in your worksheet, for sure you will do it in this column, not that column. Your practice exam, you will have this as your ERQ. Just now I look at it already. So your DTA for sure is over here, not somewhere around here. So you will have a DTA and 6,006. 6,006 is 30% tax rate of the gross profit amount 22,000. Okay, so we will understand, all this and so on. And of course, many of you try to do the parents pro forma and the subsidiary pro forma to understand things better, right? But basically the answer is only console entry. The answer required is console entry and also the console worksheet. Now, one thing is you have to know is that now it is the subsidiary sold to the parent. Maybe I write subsidiary, change the name. Subsidiary and parent. So subsidiary is with subsidiary account as what you have written in the pro forma entry. Subsidiary will have already recorded a sales of 69,000, sales of 47,000, and income tax expense of 6,006, and therefore net profit of 15,004 as mentioned over here. Okay. Now, and parent, right, actually paid 69,000 to buy the inventory. So you will have 69,000 in the parent column. And parent, because parent take it as a plant, and therefore you change it to plant. It becomes a plant already lah. Why plant is important? Because subsequent year, right, if we have a subsequent year question, you will have depreciation entries to do. Inventory is easier because subsequent period you just have to see. If the inventory sold to outsider already, then your unrealized profit will reverse. You reverse out of DTA, credit out DTA, then finish your story. But if it is a plant, right, then you have more work to do. Okay? So what is our answer? On 29th of June, our console entry, this one console entry, not the pro forma, not the individual pro forma entry, this is consolidation entry. So our console entry, we will reverse out the sales from the subsidiary book. Subsidiary name is T. So we will debit out. Your console entry normally is terbalik. So if you want to tembak an answer, you have to know. Normally it's like opposite because you're reversing out. Left hand so to right hand is not counted. Right hand so to left hand is not counted. I will reverse it out. So you will debit out the sales from Tiny Boat, 69,000, and then you will credit out cost of goods sold from Tiny Boat, which is 47,000. And then after that, you will you will decrease the plant from Monster Boat because Monster paid 69,000 to buy the plant. So of course it is 69,000 lah. It makes sense. But from the group perspective, originally this thing is at 47,000. Originally this thing is at 47,000. From group perspective, the group carry amount, it is 47,000. So our console entry, we will reduce this plant by 22,000 from MBO. Then after that, I told you the tax effect, the DTA is always at console level. So you will debit DTA, you will credit income tax expense 6,006, and the numbers are from here. Just now the black color one I showed you. Okay, then your console entry, right? You just copy paste only in the third and fourth column. If you debit, you debit. If you credit, you credit. You see, now I want to debit 69,000 sales. So you go to sales there. Okay, then I debit I follow it. And then after that, I want to debit the plant 22,000. Then I go to plant, and then credit is credit. Sorry. So I just copy credit. And then I want to credit sales, yes, 47,000. Then I just credit. And then copy paste. And then DTA, I want to debit. So you write DTA, you debit here. And then income tax, I want to credit. So I go to income tax, I credit here. Then you sum them up. Okay, template question very important. ERQ question. So you sum them up. So you look at the normal balance. We see the plant first. So for plant, right, the normal balance of the plant is debit side, right? So when debit meets debit, it is a plus. So plant 69,000 meets a credit, it is a minus because plant is debit. So 69 minus 22 is 47. So it makes sense from the group perspective. We only recognize this thing at the original price, original cost of 47,000. That's why we do that. And then because of the unrealized profit, we have 6,006 DTA from the group perspective. From the group perspective, no sales, no cost of goods sales, no income tax because it is left hand selling to right hand only. Unless parent sold the plant to an outsider, then you will see the sales at console level. It's not a sales, right? That means you will see maybe gain on disposal or something like that at console level. Do you have any questions so far? Some of you I pair you all because you are good friends, right? Don't understand, you discuss. Then you discuss, you can ask about yourself and so on. And this question I actually expanded because of Wani. Wani asked me a question, but I have not enough time. So during our exam, during our test time, actually whether you have thought of how to do NCI or not, if this question changed to NCI. So, this question, I hope that by today you have already studied multiply, but otherwise you will be okay, so this question apparently is a group account question, is a parent subsidy question, there's a control, right? But have you ever thought that if this question gives you a little bit of information and asks you to calculate how much is the non-controlling interest profit, are you able to do it or not? Okay, so now I will expand this a little bit. There are two happy and there are two, so we have a good matching concept. Okay, so now I'm going to extend a little bit. If, let's say, Monster is the parent and Monster has 60% ownership. Okay, if we add one more thing and we got to know that Monster has 60% control in Tiny. So my first question is, are you going to change your answer here or not? Okay, so you got it wrong somewhere. The 60% ownership will only have a difference in your answer when you do your pre-acquisition acquisition entry, whereby you are reversing the equity component of the subsidiary. That means when you debit out the share capital from the subsidiary book, when you debit out the reversion reserve from the subsidiary book, you only reverse 60%, one of the question later. The rest no, asset and liabilities no. That's why if you own 60%, 100%, your answer will be the same. Because you see this one is sales, plant, COGS, DTA, income tax expense. Okay? So you will only do the entries based on the ownership if it is equity related component. Otherwise, you don't care, you just do like this. Okay? Remember? So this is a takeaway that you have to remember. Yeah.
I mean, does it mean that if it is a realized profit, then we have to be, we have to reverse only 60% of it, or that?
No. That's why no.
Oh, no. No, it is a realized one.
Not like associate. That's why sometimes we will mix up, right? Okay. So a parent subsidy, you can look at case 35.4 lah. So maybe I can. So for a parent subsidy question, you will never ever have to think how many percent of your ownership for the intra-group transaction, except for the first one and also dividend. So you see, for example, should I record? Maybe I don't record it. I really mix up. Right? I want to ask. So this is case 35.4, and you will find that you see the first entry when we want to calculate goodwill, because this is a parent subsidy, not actually a parent subsidy question. And you will find that we will reverse based on our ownership. Case 35.4, if you watch it, we own 70%. So you own 70% when you do your pre-acquisition elimination entry. You will debit out the equity component of the subsidiary multiplied by 70% owned by you. So you will find actually this story if you have not watched it lah. So the subsidiary has 100,000 issue capital because we own 70%. So your console entry, you will debit out only 70,000 based on the ownership. So your ownership is important only for equity component or equity related component. So repeat earning also, we will reverse out based on our ownership. So you don't get confused because this 70% is not the net tax amount. This one is we have 70% control. So our subsidiary has 50,000 retained earning on the date of acquisition. We own 70%. We only reverse out 35,000. Then you calculate your goodwill correctly. Then later on, right, end of the year, there are many things happen, right, based on this question. There are many things. Don't know what's the question. There are many things happen at the end of the year, like intra-group, like the one that you saw, like sold inventory and blah 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 blah, right? So you will find that we do all the console entries, no need to multiply by 7. Don't have to. Sales, cost of goods sold, inventory, DTA, and also like other income, expenses, payable, receivable, long list, line loss of disposal, all this all no need to do 70%, except for dividend. Dividend is different. Why dividend is different? This story says, right, the subsidiary paid 10,000. Not paid, sorry. The subsidiary declared 10,000 dividend, and they are going to pay next year. Not paid yet, that means. So you only have 7,000, right? Because you own 70%, right? So your subsidiary said that they are going to pay 10,000. So another 3,000 they will pay to the non-controlling interest, then they will pay you 7,000 next year lah. So when you do your reversal, you will base on the 70% because it makes sense because you only own 70%. So the subsidiary will credit 10,000 dividend payable and debit dividend through retained earnings 10,000 because they are going to pay 10,000 in total. We only receive 7,000. So this is the one that you have to take care. The rest all no need. Can group account. Then we okay, then good question. Then we will come back to this question. Okay, so my question is like this. Because I think all these questions I think never ask you about non-controlling interest rate. Yeah, so I don't know whether you know how to do or not. Then my assumption is, let's say our monster controls 60% only, and therefore we know right away that the minor shareholders of this subsidiary tiny will be 40%. So we actually know that our non-controlling interest is 40%, carries 40% ownership. Yeah. So my question based on the extended version is, are we able to calculate non-controlling interest profit if Tiny has made a profit for the year, means profit after tax, of 30,000. Do we have to take into account of this scenario? Answer is yes. Okay, now only NCI we have to be careful, never mind. Only NCI we have to be careful about the direction. Direction is very important when you calculate NCI. It is in case 35.3. If there is an unrealized profit or loss from the direction of subsidiary to parent, NCI calculation will be affected. If it is from parent to subsidiary, it will not be affected. Why? Because when parent owns subsidiary 60%, NCI owns subsidiary 40%. NCI never owned parent. So when parent make whatever unrealized, nothing to do with NCI. So NCI relationship is only with subsidiary, not parent. So NCI own, what's that kid, right? NCI own 40% in subsidiary, and therefore when subsidiary has an unrealized profit or unrealized loss, it is going to affect NCI calculation. Like in this example, it will be affecting NCI calculation. So NCI is not difficult. What we will do is, we know that the unrealized profit net of tax is 50,004. NCI no need to do DTA and all that. So it is a little bit like associate, but easier than associate. So your associate also we look at profit net of tax and then times the ownership you own, right? So this 50,004 is the profit net of tax which is unrealized because it has not been sold to external party. And you just have to do this step. So NCI profit is equal to 30,000 profit earned by the subsidiary company T minus 15.4 thousand unrealized profit. Not yet realized, that's why we minus out. Okay, if it is unrealized loss, then the value you plus it. So there is a profit, but some profit inside is not realized yet, so I want to minus it out. So I minus it out already not enough because I, as the non-controlling interest group, I only own 40%. So this NCI is not one people, it's like many minor shareholders. Otherwise, you will confuse again why this company is not associated with NCI again. So this 40% non-controlling interest is made up of many shareholders. All together, it is 40%. Okay, so we multiply by 40% NCI ownership. It is equal to 5,840. And this is your answer. And now I want to extend it to a little bit more difficult question. Okay, for this question only, the rest no. This question is very deep. So as we know from this question, right, parent bought the inventory and take it as a plant. Okay, for ordinary business purpose and all that, not going to sell it, it's not for resale purpose. So we are now assuming that the plant, so this is one story, that one is another story, then later on we will come back to our NCI. So what I want to say is the plant is depreciated at 10%. Okay? the plant is depreciated at 10%. What are we supposed to do? End of the second year. So now this is last day of the year, almost the last day of the year. So now our question is 30th of June, X9, that means X9. What are we supposed to do? Because I want to show you when you have a multiple choice question and you really have no time to think so long, what is a shortcut? Because the unrealized profit, if it is not an inventory, okay, it's like this, let me repeat one more time. Now, if subsidiary sold inventory as an inventory to plant, very easy. Now we have unrealized profit, and we will expect the parent will sell the inventory next year, the kind of inventory you have to put 10 years. Right? So next year when the parent sold the inventory to somebody else outside external party, this unrealized profit will be realized. So the thing is very important, very easy. So in the second year, right, you just have to credit out your DPA 6,006 and then debit income tax expense 6,006, and then you don't have that inventory anymore. Something like that, this is shortcut. However, if the inventory is sold and treated as a plant, then there's a bit of trouble because we will have a plant not going to be sold to external party, but this unrealized profit will also slowly be realized through depreciation. That means, right, end of the second year, you will also credit out your DTA, but not the whole thing. You will credit out through depreciation amount. Okay, if you don't know what I said, never mind, you think slowly. You think slowly and do it. If you cannot do it, then you do it together, never mind. So now we try to imagine we are in the second year. What are we supposed to do? Now, the parent, right, will depreciate the plant 10% based on 69,000, right? This is this is case study 5.2 or 5.1, I forgot already. 5.1. This is 5.1, this is 5.1. So the parent will depreciate this plant 10% based on 69,000, right? Can or not? So the second year that time, X9 that time, the parent will debit depreciation and credit accumulated depreciation. So the parents pro forma entry no mark, just for us to understand the mark is for also entry. So the parent will actually debit depreciation 6,009 and credit accumulated depreciation 6,009. So the parents in the parents book, the net book value of the plant is equal to how much? The cost is 69,000, right? Parent pays 69,000, the cost is 69,000 up. Two. This one 69,000. Then you minus 6,009 lah. Accumulated depreciation equal to long way. So this is a long way first. Long way can understand easier. It's 62,001. 62,001. Okay, so this 62,001 is the tax base. Tax base is always based on that party that pays money, no matter it's a parent or subsidy. You don't memorize whether it's a parent or subsidy. It is the buyer lah. So parent pays 69,000 to buy the plant. From tax perspective, it is deductible slowly. Therefore, tax base for sure is based on this amount. If you don't know, then never mind. Tax base is the one either the parent or subsidiary, and carrying amount is from the group perspective when we do group account question. Okay, so if you still don't know, then I will tell you the shorter cut lah with the. Okay, so parents do this already, then we have to think from the group perspective. From the group perspective, we don't agree on that because this plant originally is at 47,000. 47,000. Originally, from the group perspective, it was supposed to be 47,000. Okay, so if we use 47,000 times 10%, the depreciation is supposed to be 4,007, right? 4,007, right? From the group perspective, our depreciation is supposed to be 4,700, 47,000 times 10%. So can you give a guess the easiest one first? What are we going to do at console entry to adjust it to 4,700? from, oh, I forgot to claim now. Just like I stopped at where I took over it. Okay, so if we assume that the plant is 10%, the parent will actually depreciate 10% based on 69,000, which is 6,009. So the net book value sitting in the parent book will be 62,001, and this is a tax base. So tax base is actually the amount of the buyer because they generally pay for that, right? So that will be the tax base. It is tax deductible. Now, from group perspective, it is not 69,000, it is 47,000, the original amount. So we are supposed to depreciate 10% based on 47,000 based on the group perspective lah, which is 4,007. So our console entry, what are we going to do so that eventually our depreciation will become 4,700? What are we going to do? What are we going to do? You have to, reduce lah. You have to reduce, right? Yeah. You have to reduce depreciation from 6,009, eventually it becomes 4,007 by how much? 2,002, right? So we will have to reduce 2,200. So reduce, we do the balik. We debit out accumulated depreciation 2,002. We credit depreciation 2,002. Because if we reduce by this amount, the movement, eventually only we will get 4,700 depreciation expense as what we want from group perspective at console level. So now we try to think from group perspective. The group perspective one is the carry amount actually. The group carry amount is equal to original cost 47,000 minus the depreciation in 10%, which is 4,700. Okay. Equal to 42,003. So this is actually our carrying amount. So you compare lah. This is an asset. When this is when there is an asset, when the tax base is higher than carrying amount, it is a deductible temporary difference, which is a DTA. So what is the difference? The difference is 19,008, right? So this is actually related to the before. So our tax base 62,001 is larger than our carrying amount for the 2003, and therefore we have a deductible temporary difference. The difference is 19,008, and we multiply by 30% tax rate. It is equal to DTA carry down. Remember, because if there is a brought down, then your answer is wrong already. So DTA carry down is 5940. Carry down, not your journal entries yet. So this is the second year, if you remember. So in the first year, we have a DTA of 6,006 debit side. So the second year, your DTA memang is 6,006 lah. So from 6,006, I want to reduce to 5,940. So what am I going to do at my console level? I want to reduce, meaning you will, the value will be credit or DTA. That's why I say your DTA will be credited. Your unrealized profit will be realized but slowly through depreciation. And this is what I meant. So we will actually credit DTA and we will debit income tax expense. 6,006 minus 5,940 is 660. So this is your answer for the movement. You are reducing it by 660. And you can stop here if you are not experienced enough, if you feel very confused already. Otherwise, if you have a multiple choice question, you will know. This DTA comes from unrealized profit. 6,006 comes from unrealized profit. The whole story is lah. And now we will depreciate over the 10 years. The unrealized profit will realize slowly over the 10 years. Our DTA will be reduced over the 10 years. 6,006 divided by 10 years is 660. End of every year, we will credit out our DTA by 660. Okay, or you can match back your answer. You might not be able to remember or the whole flow. So my last question for this question is, if 30th of June X9 Chinese profit is equal to 50,000. Are we able to calculate non-controlling interest profit? That's the question. This is a popular question. NCI profit is a popular question. Just to inform you if you do not know about it. Okay, so you are able to okay, so in the first year, what did we do? NCI profit, we use the tiny profit minus out the unrealized profit. Well, profit has not been realized, you minus it out from that profit, you minus out, right? But you have to know the concept is always unrealized profit is not forever unrealized. It will be realized slowly. That's why we say this is a temporary difference. The gap will reduce. Your tax base and carry amount is different. However, their difference will reduce because they are depreciating. They will depreciate slowly until it becomes zero. And therefore the gap will reduce. So, we will know that this unrealized profit will slowly be realized. And what are we supposed to do is like this. We will use 50,000 profit made by our subsidiary Tiny in the second year based on the assumption only, not in question. And then we will plus. Because unrealized profit, when it is realized, you will plus it back. Again, makes sense, right? You will plus. And how much you will plus it? So you will actually try to look back the depreciation 2002, right? 2002. But 2002 is actually the unrealized profit being realized gross amount, not net of tax. So we will use the unrealized profit because this one you see, this 2002 comes from where you know not? Comes from this 22,000 divided by 10 years. And then you know we have to do the net of profit, blah blah blah, right? So this 2002, is the gross amount, and then you have to do the tax effect out. So 2,200, you see credit side already, right? So credit side already means it is a profit, unrealized profit has been realized. Credit is profit, debit is expense. So we know that we have to plus. Depreciation has realized our unrealized profit last year a little bit. So we plus 2.2 but not enough. We have to make sure it is net of tax. So we multiply by 0.7. So it is 1,540 lah. So it is actually this 15,400 divided by 10 years actually. So it is 1,540 realized profit net of tax. But we don't forget because NCI is 40% altogether. So we don't forget to multiply 40% NCI ownership. So it will be equal to 20,660. This is your answer already. And therefore, the faster way, or let's say you have 10 seconds to answer the last question. The last question is an NCI question. So what are you supposed to do? If this is the second year, if this is the third year or fourth year or fifth year, right? And when you have this kind of story, right? For sure you know the unrealized profit has been realized through depreciation, net of tax. Plus it with your with the subsidiary profit, the whole thing multiplied by the NCI percentage. Then you may be able to guess the correct answer or the closest correct answer. This might help too. So before I give you a break, we do one similar question first instead of module 6. Just now this one is for 7. Or we do one more question, question 8, correct? Sorry, who called me? No one. That's horrible. We do one more question only, we take a break. I hope that I'm not the only one who is very energetic. I spend a lot of time to prepare this seriously. Because I have to think how to make it clearer. Okay, we do the last question, then we go for a break, just to motivate you. Okay, question number 8. On 1st of July X5, this is the first day of X6. We purchased 70%. There we go, Shafika. We purchased 70% of small. So we have a parent-subsidy relationship. Intra-group transaction, don't bother. But the first pre-acquisition elimination entry, yes, we have to bother about it. Now, 450,000, what is this? This is the consideration. Okay, so this is the consideration. Then we are looking at the fair value of identifiable asset of the subsidiary. You can look at the equity component or asset minus liability component, they will be the same. So for this small company, issue cap is 210 and retained earning is 90. So what are we supposed to do? In this question, we don't even have a revaluation upwards. So it is quite straightforward. So we are looking at the equity section of this company, issue cap 210, retained earning 90. So the fair value of identifiable net asset is equal to how much? 300,000, is it? Yeah. Okay. So you buy how many percent? 70%, is it? Yeah. So you read like this. For those who have not studied or you blur already, you read like that. Okay. I, as a parent, I use 450,000, buy 70% of the subsidiary worth 300,000. You read like that. So if I buy 70,000 of this company, that means how much I buy? This 70% times 300,000, it is 210,000 lah. So I use 450,000 to buy 210,000 worth of company. Am I paying extra? Yes. So I use this amount to buy this value of amount of company. I'm paying an extra of 240,000. I'm paying it as a goodwill. Later on, your answer must have a goodwill. So we do a console entry. Now, just now I told you, equity component must reverse based on your ownership only. So our ownership is 70%. So the equity component, which is issue capital and retained earning, is 2. When you debit it out at console level, you have to multiply 70% owned by you because you only own that much. So you cannot reverse the NCI version. Okay? So 210,000 times 70%, it is equal to 147,000. So you just multiply by 70% now. And then retained earning is 90,000 times 70% is 63,000. So you debit out retained earning of subsidiary based on your ownership. And then your own consideration you credit out because in your own book what you will do, anybody can tell me. In your own book what you will do for this 450,000 consideration. In your own book is the big book, your pro forma entry. You will in the big pro forma entry, in our own book, in the big pro forma entry, we will debit investment in subsidiary or in small also can, 450,000, and then we will credit cash, 450. So this has to be reversed because you got married already, so it's not really counted like investment, and then you have to reverse it out. So you have to credit, you have to debit it, you have to credit it out. So this investment in subsidiary, the whole thing, because this is the whole thing that you pay for. So the whole thing, 450, you have to credit it out. You have to credit it out. Then after that, you will find that there's a short of 240,000 on the debit side. Journal entry, make sure your total debit and total credit has the same amount. So 450 minus 147 minus 63, there's a leftover of 240 on the debit side, which is a goodwill. Same as what you have thought logically just now. Yes, my goodwill is 240. I paid 240 extra. Then you finish the whole story already. Okay, so you want to take a break or not before we look at module 6? So do you have any takeaway? Do you feel like it is clearer for you already by now, although we are only covering a bit of the question? Are you okay now? For those who actually score a bit better, thanks for bearing with me. And please help your friends lah, maybe next to you girl, whoever girl. Help your friend maybe in your language you can explain better, you know, so on, because you are in the same age group, right? Yeah. So we will take about 10 minutes to 15 minutes. Start again. This one, all the answer.
Nak jawapan yang ni? Jawapan nombor 8. Oh, yang tu je lah.
Itu je. Lepas satu lagi yang dekat
Dekat big kan? Yang big ni je kan? 450, yang 450 kan?
For those who score above 30, consider very good already. Up to this stage lah, because normally you will study very, very hard 7 days before, right? So up to this stage, above 30, consider very good already lah. And for those who ask me what you have to do, I think your email says there's a 10 days work camp if you have lost and you want to go on track. You can follow that thing. Okay. So I think we will take a short break and we'll start later. You just write out whatever you want to do. You study for this 6, right? You didn't study for the 5.
Mira kata ada
Aku sengaja tu belum ada soalan tau.
Yang dua pun betul-betul tapi beda lupa. Dua soalan beza.
You know there is a Word document in your WhatsApp, right? You can follow that at the same time. I tell you what to do first. You totally forgotten or not? Totally forgotten or?
Regarding 7.
Question 7. Okay.
The last one,
Yeah.
what are we the 2.6k? What we multiply by
70%.
Okay.
what is 0%?
Okay. So over here, maybe I should write 22,000 if that's the case. Now, the profit, okay, we sold 47,000 for 69,000. Subsidiary sold 47,000 for 69,000. Subsidiary make a gross profit 20,000. So net of tax will be 15,000 to know how much forgot by multiplying 47. So if you use 22,000 times 30% tax rate is 6,006. 22,000 minus 6,006 is 15,004. Right? So instead of doing that, you can use 22,000 times 0.7. 1 minus 30% tax rate is 70%, which is 0.7. So this story is the same. 2,002 is the gross amount of depreciation. Okay? Then you can use 2,002 times 30% and use 2,002 minus that 606 or use 2,002 times 0.7.
So basically 0.7
Net of tax. The rules, net of tax. That means instead of using this minus this already, get the amount, use this minus this. Macam like one shot lah. Can right? Yeah.
Macam dapat 2.2 ni?
Okay.
Oh, nak check.
The current one, you need to go and find out the current one. They are overlapping, right? Yeah.
Ya, nak tahu tak? Kan macam bila kita buat pasal tektor dengan database temporary difference macam tadi kan, kalau macam ada conflict macam belum analyze semua tu kan. So kalau macam ni interresistible in soft is 1000, dia memang carry omong dah. Dia tak ada nak macam tak sebut tu.
Maksudnya kalau benda tu dah soft P, kan tu yang kalau maksudnya kalau benda tu dah ke financial position, dia memang dah final punya amount macam tu.
Bukan sebab dia sekejap ambil yang lain.
Sebab yang tak, sebab kalau ni yang ni kan dia 1000 lah. Lepas tu macam mana dia tahu yang dia tu okey nak cari ni tahu, tapi macam ni macam mana
Yang ni
tahu
kan yang
kosong?
macam
Macam
yang
mana tahu
kosong.
yang ni kosong?
Ya, trade receivable has carried amount of 20,000. The revenue has already been included in taxable profit.
Maksudnya
Dia tak
flexible.
benda ni dia dah sama. Ni yang ni dengan sama dah kosong lah. Kalau tahu okey, cuba tengok yang Aini tu. Macam mana Nina betul Aini tu? Sebab Nina betul yang Aini kan. So, macam ni Nina betul yang Aini. Ni fit salah pula. Yang ni macam Nina betul. Macam Nina buat. Siapa yang Nina faham?
Ikut yang tu sebab tengok yang DTD DTE tu.
Sebab net reserve value dia 5,000. The reduction is mungkin sebab ni senang dia cakap pasal ni kot take purpose yang 5,000 tu. So that's why tax base tu 5,500 dia tak includekan lagi.
Tak, yang ni kan tengok yang tu tau kan medium ada tunjuk yang pasal kalau asset TB lebih daripada CA dapat DTB.
Oh yang ni ke?
Yang tu ikut yang tu macam lihat.
Kalau Fit pinjam buku Mas Dalila ni. So Fit jawab yang sini je. Sebab dia punya ni dia buat kat sini. Yang dia aku rasa dia ke medium lah. Mana dia ni? Ni.
Sama lah ikut yang ni tu.
Fit ikut yang ni. Fit buat yang ni. Ni fit betul ke?
Betul tu.
Yang ni sebab fit fikir macam interresistible, macam dia tak ada pun cakap dia tak termasuk ataupun benda tu dah sama dengan tax base dengan carry amount pun sama.
Salah sebab maksudnya maksudnya sebab dia dah financial condition jadi dia dah
Fit ambil yang macam tu lah. Dia macam tak ada benda yang macam unrealized, and then benda tu dah ataupun tak ada benda yang macam temporary. Dia dah include dalam tax base tu. So that's why tax base jadi kosong. Kalau macam contoh kenapa yang ni 5500 kan? The reduction is ignored for tax purpose. So dalam tax base dia yang 500 ni tak masuk lagi. So dalam tax base dia masih ada lagi 500 yang dia kena ada DTD. Macam tu apa?
yang ni jap. Ni kenapa jadi bukan DTD?
Liability.
Oh.
Ni lah.
Ya.
Benda ni ada liability sebab ni lah. Accrued expense tu liability. So Fik tengok kat sini, tengok Fik buat CA lagi besar TB DTD. Dia ada asset, dia ada liability. Rasa yang ni macam bagus gila untuk soalan bulat-bulat. Macam cepat.
Minta estimate kuah soalan ni je. Memang tak. Kalau keluar soalan ni
Taklah, external keluar tapi jenis entry. So jenis entry dia bagi DTD, DTA ataupun DTL. Kena tahu ke macam mana dia boleh jadi DTD tak ada bukanlah.
maksudnya
Jenis entry macam mana? Tengok buat tak jenis entry?
tak, jenis entry. Okey kan bila contoh
Okey, contoh
ada
contoh buat yang ni,
kan,
buat yang ni.
500 kan.
Yang 500.
So dia akan ada macam debit, jadi yang dengan realized profit tu dia akan wujud benda tu.
Dia kena kali kosong bagi juga ke?
Tak payah.
Oh dia
Amount yang
amount 500 je lah. Oh.
Bagus tu.
Ke yang ni?
Yang dia recognise tu kan? Pasti lah.
Tak tahu. Jenis entry kita tak tahu.
Tahu balik dah belajar.
Okey, yang ni kenapa satu 35,000?
Nah,
Yang ni. Okey. Carrying amount tahulah. Carrying amount bagi tahu. So take base je. Okey. Cost of ni 50,000.
buat macam ni. Ni carry amount tambah FTD, future taxable, future deductible tu. Ni. Kan kita ada future deductible 15.
Ni future deductible.
Bukan. Okey, macam mana? Dia apa? CA tambah FD tambah FD tolak FT kan? Ni taxable.
Yang ni.
Ha.
Ini kita panggil apa? Future apa?
Future taxable.
Dia CA apa tadi?
CA tambah FD kan? CA tambah FD.
FD tu apa? Future deductible.
FD ke FD? Future deductible tolak dengan future taxable. So carry amount dia 50. Lepas tu future deductible dia tak ada.
Okey. Tambah kosong lah. Tolak future taxable. Macam mana tahu CA ni future taxable?
Capital allowance tu sebab dekat note ada final apa dia tulis pasal future taxable.
Capital allowance tu future taxable. Kalau buat kat dalam tu tambah markah. You siapa punya tu? Buat tak dekat ni? Dekat ni tak ada. Fik pun tak buat. So dia ingat kita tak buat. So dia tambah markah kat tu. So dia tanya. Saya tak makan kena sangat pelik masuk nasi. Kadang aku paling rendah dalam kelas ni. Dapat 2 je.
Oh, meja tak tanda
Tak tanda. Tadi pun medan baru je tanda.
Cik dia 11 per 20. Darab 22 per 20. Cik dia 22%.
Janganlah.
Kau ni aku nak tanya lagi.
Tak, sebab kita calon-calon yang dapat lulus nanti.
SD okey.
Tengok dia pergi dia. last one.
Ni Fiat Accent ni.
Eh,
Dia DTD tu dia tak ada kat dalam debit pun. DTD tu sama ada dia DTA atau DTL. So betul lah kalau macam ni.
lepas tu yang ni cuma satu je.
Ni je.
Lepas tu tak boleh.
Tak fit langsung macam kena buat journal entry tak ada. Tapi aku rasa memang tak buat aku tu. Macam tak study lagi ni, tak study tak ya. Tak, yang ni pun okay. Yang mana? Yang ni pun kan. Saya rasa macam Mas Jadilah punya ni bagus sebab saya tengok kat sini je. Prima facie benda. Tak expand. Saya tengok ni. Okay, ni je lah aku tengok. Lepas tu yang benda kan macam tak ada kan. Macam group account dia tak ada. Group account dia macam tak ada debit credit pun. So macam kalau tak study memang tak tahu lah.
Betul-betul short
Dia macam betul-betul short untuk
sebab yang dia memang fokus untuk calculation.
bukan dia tak fokus untuk calculation. Dia fokus untuk teori apa orang panggil macam basic. Apa benda yang kena faham. That's why macam
apa benda yang kena
kalau
wajib
macam
tahu.
saya rasa macam bila you dah study, lepas tu bila nak jawab soalan different ni je. Tapi kena dah study, kena dah tahu debit credit supaya macam kita nak kena ingat apa benda yang wajib masuk, apa benda yang tak wajib masuk. Tu je lah. Jangan tak start.
Sebab dia problemnya dekat tu chapter 5 part yang lain
Tapi Nina honestly tengok tak video?
video apa?
Honestly Nina tengok tak video?
Video KI.
Bukanlah apa-apa lah yang minum ni. Modul tak? Tak tengok ni. Tak tengok buku je lah. Biasa logik apa?
Kena tengok dia baik lah. Tapi kalau pendek semua dia punya debit credit kan ni.
Tu lah. The total or what? Template.
The question 18.
For question 18 only 9 plus 9. Dia tangkap semua. Mana nak guna?
Modul 7. Nak tengok modul 7.
Okay, we will start now. Try to finish it.
12.
By the way, if we do practice exam next Thursday, because the lab is fully occupied for the whole day, I think. So, do you think it is doable if you bring your laptop because it is 3 hours? But 3 hours later, no battery, right? How did you do when you did your HE exam question? Online day?
Able to
But in our normal class here got extension. But the software is like free only. That means you take turn to charge. And then how about the rep? Which class?
808.
Oh, it's
807.
tapi kita tak pakai charger kan. Cukup kan.
You prefer to do it using your laptop or you prefer to do it in the lab?
Ada Pak Etik ke?
Member
Dia kan mesti MIA. MIA. Member tiba-tiba ambil set dia terus.
Yeah lah, but Fujiko already. Next Thursday.
Dia tengok ada langsung.
Satu tes dua.
Tak tiba-tiba macam tak dapat.
Yeah, 9 to 6:30 also cannot. In 8.07, I can change curriculum like that. Okay.
Main minor water.
8.07 more socket, I think. 8.07 is better. They pick like all the students. Well, I never go 8.07 is.
Asal?
You.
No, I will figure out. So tentatively, right, next Thursday, right, you don't do your practice exam first, 1 and 10 already. So next Thursday, we do our practice exam 9 o'clock until 12 o'clock. And then after that, we will discuss the answer 1:30 in 8.08. I will use my ICS class. Room. Classroom. Okay? So whether we can do it 8.07 or not, let me figure out whether you can fit in so many people. Then you bring your extension and blah 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 blah. You bring your own laptop. So we do it together, and then before you forget your answer, then we discuss immediately. Practice exam 1 is it's very difficult. For me, it's very difficult. I felt that it is very difficult. Okay? So we will start now. We will do question 9. Yeah. Okay, we will speed out a little bit. Alright, question 9 is a module 6 question. So, Juice Mining Company holds 1,700 ounces of gold. Now, do you remember this question is very similar with our field question in the textbook? We own the how many barrels of oil, how many barrels of oil, that question. Okay, so whenever you are having this inventory sitting in already, okay, you will not use a cash flow page because you will not have a cash flow page or OCI. I think some of you answered in such a way, right? You will not have that. Okay. So now our inventory goal apparently is our H item in this story, and then we hedge the exposure against the price of gold, and therefore this question is probably talking about fair value gauge. And then we enter into a forward derivative to fix the gold price at the current price of 1,400 per ounce. And then 30th of June, X8, the spot price of gold is at 1,560 per ounce. Then we will have to prepare the journal entries only on 30th of June, X8. So what are we supposed to do? Are we happy or not? This is not a happy case, by the way. So we will try looking at it now together. So first of all, as I told you, this inventory is a H item. Okay, so this is our H item. And then we are looking at how many units? 1,700 ounces. This is the units, not how much. And then our H instrument is forward derivative. So this is our H instrument. So if you have a journal entry, every time you will have a H item, you will have a H instrument. One of it will have a H loss, one of it will have a H gain. It is always like this. So at inception, we normally do not have any journal entry. That means if the question asks you what you have to do on 1st of July X7, you should know the direct answer is nothing to do. No debit, no credit, nothing. Okay? Now, so we know that we have locked the price $1,400 per ounce. So later on we will multiply by the units. And on 30th of June X8, which is the one that we want to answer now, the spot price of the gold dropped to increases to 1,560 ounce. Okay, so if you look at my demo here, at inception, this is not your journal entry because your inventory is sitting in your balance sheet. You get what I mean? You always hold all this and you are not selling it that fast, for example. So our gold inventory carried out is 1,700 units times 1,400 current market price on 1st of July. This is only for explanation, not your answer. No journal entry when you enter into the forward contract. and we assume that we are holding the gold, we have not sold it and all that. So on 30th of June X8 at time, the gold price, the spot price of the gold commodity has a higher realizable value, which is 1560. Now what happened is our inventory will increase by 160 per unit times 1,700 units, which is 272,000. Now, if it is not a hedge accounting, you will not do anything, you know, right? If it is not a hedge accounting, you will not do anything because inventory IS2, it is the lower of the cost versus net realizable value. So you will still use your lower amount, the amount you purchased. However, hedge accounting, right, you have to reflect it based on the fair value. Fair value. So on 30th of June that time, when your gold price increases, are you happy or not? Answer is happy. But at the same time, you are not happy at all because you have made the wrong move to enter into this forward, which is unfavorable. If you're not going to do anything in the first place, the gold price increases, then you have the privilege to earn more money, you get what I mean? Because the market price increases, you sell like at a higher price, and then you bought a long time ago at a lower price, you are very happy. But then when you enter into hedge, right, you may not happy already, then the money you have to pay to the forward derivative holder, then it will be set again because you are locking the price, you fix that price. So whatever extra that you might have received, you will pay to the forward derivative company. So when you have a gain, you will have a loss at the same time. Sometimes same amount, sometimes different amount. Okay? So now, our inventory is increased by $272,000 because you will take the difference, 1,400 last time the old market price on 1st of July, and then now the market price on 30th of June, X8 is 1,560. So the difference, it has increased by 160. So it increased by 160 times the gold you own. So the amount is this. You will debit your inventory 272, and then you will credit hedge again 272 because now we are using IFRS 9 hedge accounting. And then at the same time, we will debit hedge loss 272, and we will credit forward derivative 272. So if you look back how many barrels of oil in the textbook, the study guide that we discussed before, it's more or less the same, right? But that one is a happy case. Okay? Then we will look at question 10. Question 10 is a very simple question. Yeah. People say already, buyback is not a real sales, right? When you have a buyback agreement, you don't recognize your financial asset like selling it, right? Cannot, right? So buyback is the keyword. Okay, so we are now looking at question 10. On 1st of January, we sold our financial asset for 12,000. Okay, our carrying amount of financial asset at the time is 10,000. And we will buy it back on 31st of December, end of the year, for a higher price. Apparently, we cannot recognize the financial asset. It is a loan. We don't have enough money. We draw a contract like we sold to impress or to make our balance sheet looks better and things like that, which is wrong. So what are we supposed to do? Okay, throughout the whole year, we will actually recognize the loan immediately on the day of sales, which is not a sales in substance. So you will not be recognized a financial asset. There's the story, there's an example in the question, the MCI question, right? So in the textbook, right? So you will actually receive the money, 12,000. However, it is in the form of loan. You are not selling something to get money. You are actually borrowing. You are borrowing money and you want to manipulate the account, which is wrong. So you will debit bank 12,000. You will credit loan 12,000. So your financial asset carrying amount is 10,000. Are you going to do anything? No. It will carry on because you are in control. In substance, you are still controlling the financial asset. Okay, so it is not like I sell already, I buy at a higher price, 15,000, like my financial asset is very sellable like that. No. So when you make a payment end of the year for 15,000, you will credit money 15,000. I mean, this is the easiest easiest one. You will credit bank 15,000. You will be recognized the loan because you settled your present obligation already. The 3,000 extra you pay is not, and it's not like your financial asset is more valuable after a year. No, it is the interest that you pay for. Because at that time you have not enough money, you borrow money. So this is the loan interest. Some students have two answers. I'm so confused, you know how to mark already. Some of you, right, you sold your financial asset on 1st of January, Saturday, then Saturday 31st of December, you recognize the loan already, then after that you recognize. This is the correct answer. I might give you like 2.5 marks, but that one is wrong. This one is correct. Okay? We will move on to question 11. You tie it back with question 1, multiple choice question. Now, this is a convertible note, right? Now, whenever, every time, when you have a convertible instrument question, you know that you will be the issuer. For our syllabus, it is always like that. Convertible instrument, for sure, we will receive money and then you will credit liability, a lot of liability, a little bit of equity. Okay? So, that's the direction. Now, so we issue 2,000 units of convertible instrument. It is $750 per unit. Some of you answer $750,000. You know why? So you use the number lah. You see 2,000 units times 750 per unit. You are supposed to get $1.5 million, right? $1.5 million. It is a 2 years instrument. We have to do present value. Now, interest is payable annually 8%. When the sentence is written like that, what is the meaning? This 8% is actually the coupon rate. When interest is payable, because your cash outflow is the note rate, it is the coupon rate. Okay? And then each instrument is convertible to 250 ordinary shares. It's not very important when you do your journal entries. And then, okay, the prevailing market rate, just like I told you, when you see prevailing, blah, 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 for the instrument, you know, it is actually the effective interest rate. So, effective interest rate is 10%. Okay, I think some of you took the wrong number to look at the table and all that. So, what are we going to do at inception? Only at inception. Alright? Now, I told you this kind of note is more expensive because there is a privilege for those people to convert themselves into the shareholders. So you will know that, number one, the 1.5 million itself will be your cash inflow at inception. You will receive a lot of money and then you will credit most of them as liability, and the residual, the balance, the difference, you will credit it as equity. So the next step is, how do we know how much liability we have to credit? So first of all, you should know you will debit bank 1.5 million. And then after that, we want to calculate the present value of liability. Okay? Now, so you will actually look at the table. You can actually look at the table. And then you go to the present value table, table 3. You can do table 3 because 2 years only, right? So you will have to calculate the present value of the future cash flow. How do we know in future how much is it, right? So you can draw a simple timeline. So now I receive 1.5 million, that's my cash inflow lah. So end of the first year, how much I have to pay? Just now we say interest is payable annually at 10%, right? So you will use your 8%, 8%. 8% is the note rate. So you will use 8% times 1.5 million. Then you will get how much? 120,000, right? So you use 1.5 million times 8%, that's the note rate or coupon rate. Then you will know end of the first year you have to pay 120,000 in the form of interest. But this might not be the interest expense that you recognize because the coupon rate and effective interest rate is different. So end of the second year you also have to pay 120,000. Okay? So if nobody convert the convertible note, right, then you have to pay off 1.5 million. So this is what we will do. So you can use present value single cash flow if you think like 2 times money or annuity also can. So today I will do this method. I do this first year and I do this group second year using table 3. Okay, so it's up to you. So I want to know 1 year, right? 1 year down the road using 10% effective interest rate. You remember, right? Effective interest rate is 10%. 120,000 1 year later is equal to how much today? So I look at 10% and 1 year. So it is 0.9091, right? So you use 120,000 plus 120,000 times 0.9091. 120,000 times 0.9091. Okay, it is equal to 109,000 today. And then after that, I take the other one as another group, which is 1.62 million. So I want to know 2 years later, 10% is equal to, 2 years later, this amount, 10% is equal to how much today? Which is 0.8264. 2 years, 10%, 0.8264. 0.8264 times 1.5 million plus 120,000. So it is equal to 1338.77. So if I total them up, it is equal to 1.44786. And this will be my liability. The present value of future cash flow is my liability, 1.44786. This one I use formula, that's why it's very precise. So you write 1.447,860, and then the leftover 1.5 million minus 1.447,860, you will get 52140. So the residual, the leftover, will be our equity. Okay. So this is the answer. But you have to make sure you know how to do the next year, and also you have to make sure you know how to do the table. There's one table that the template that you can do, maybe is a possible ERQ question, that you can find out your liability carry down every time. That way you have to learn. So if you remember, I told you the interest expense is always based on effective interest rate times the latest liability. The latest liability times 10% is the next year interest expense. Okay, so for example, if I want to do like 1 year later, or in this case it's end of the year, so if I want to do this 30th of June 20x8, if I want to do that, I will have interest expense not based on your cash outflow, but based on the latest liability, this thing, times 10%, times 10% effective interest rate. So I will debit interest expense 1.44786, and then I will credit money cash outflow because I have to pay 120,000 if you remember. And then the leftover, I will increase my liability. That's the unwinding effect of effective interest rate, unwinding effect of discount rate, which is 24786. So I will actually adjust my liability along the way. I'm actually increasing my liability from 1.447 slowly to 1.5 million, so that by the end of the second year, my liability will become 1.5 million. Actually, we are doing that. So you do like slowly until the second year, then you can see like the whole picture if you want to. I pause for a while. Do you have any questions? So we will move on to question 12. Okay, question 12. Now question 12 again is a derivative question. So on 1st of July X4, farmer holds 1 million units bushels of wheat, and then on the day the farmer purchases the forward derivative, fix the price at the current spot price of $6 per unit. So it is matured on 30th of September. Monthly spot rates are as follows, and so on. Now, so by now we should be able to know 1 million bushels of wheat is our H item. H item, okay? And then the forward derivative is a H instrument, H instrument. And then at inception on 1st of July X4, no journal entries. No journal entries. Okay, so because this is about similar like the question just now, we hold the inventory and then we are very worried, so we enter into we are very worried that the market price is going to drop, so we enter into the derivative. Okay, so it matures on the 30th of September, and these are the few points that we have to do our journal entries. So $6 times 1 million number of wheats is $6 million of wheats, and we are looking at the movement. So now I'm going to look at the movement before I show you the answer. So let's see what is the movement. In the beginning, my wheat is like 6 million. So end of the first month, $6 increases to $6.20 by 20 cents. So when the market price of the wheat increases, I'm supposed to be happy because I hold it, I bought it at a lower price, and then now I can sell it at a higher price. Of course, I'm very happy lah. So my inventory will increase by 20%, not 20%, 20 cents. So I will use 20 cents, $6 minus $6.20, 20 cents times 1 million units equal to 200,000. So my first journal entry is on the second day, second point. So 31st of July, that time, I will debit my inventory 200,000 because it is up 20 cents times 1 million units. And I will credit H gain 200,000. Now, so now you know whenever you have this kind of question, it is always like that. When you have a H gain, you have a H loss. Okay? So you will actually debit H loss and you will credit forward derivative. So sometimes your H instrument is available, sometimes it's a receivable. It really depends. At this moment, your H instrument is available. That's why you don't memorize. A lot of students ask how to memorize, how to understand this is available or asset. No need. Don't have to. Okay? Don't have to. Now, then we will look at the next one because you have to do everything, right? I think module quiz asks you to do like 31st of August only. If I change it, I want you to do everything. Okay? Now, so second point. Second point is $6.20 drop to $5.90. So you will look at every movement, not from here. So you will look at here to here, here to here, here to here. So the second point, you look at the movement here. $6.20 to $5.90. There is a drop of 30 cents. Then you will find that, oh, luckily I have hedge. Because the market price dropped already, I can sell like a much lower price, but never mind, I'll be compensated by the forward company, forward contract company. So in the second journal entry, you will see that you credit your inventory 300,000 and you debit H loss 300,000 because there is a drop of 30 cents during this period, this month, one month movement. So when you have a H loss 300,000, for sure you will have a H gain at the other end, and you will debit, in this case, you will debit your forward derivative. So I think your MIOL stop at this point. So it is a happy case. Because MIOL, I think, asks you up to 31st of August, then what happened. So up to here, right, it is a happy case actually. It is a true move, correct move to enter into the forward derivative. However, if we want to do all one shot, the last point, $5.90 increases again to $6.10 by 20 cents. So we are happy because our inventory increased by 20 cents. So this one increased up 20 cents. So up 20 cents, your inventory will be increased by 200,000 with the hedge gain 200,000. Unfortunately, we enter into the derivative. We have to recognize the hedge loss and credit out the forward derivative 200,000. So end of the day, happy or sad, confused already, never mind. You go and find out your account title with forward derivative, you sum them up, the grey color one. Now you see, first time I credit this grey color. First time I credit 200,000. Second time I debit 300,000. Then it all off. So there's a 100,000 debit side. And then third time I credit 200,000 block. Then you net off. So now I have a 100,000 credit side. That means it is a payable. It is a sad story. So now mature already, right? So we have to settle already. We settle at the net amount. So the net amount is 100,000. We debit out, we recognize the derivative, make it to zero, and you have to credit money. That's the time you have to pay. So you pay 100,000 and you de-recognize it. What is the other way of double checking whether we have any careless mistake or not? Is you can look at the first point when you enter into this derivative and the merchant date. That means this day and this day. So in the very beginning, we enter the time at $6. We lock it $6. But now it becomes $6.10. So we are happy the market price is higher. We can sell it at a higher price. But the happiness will actually have to compensate to our forward contract company block. So the 10 cents times 1 million, which is 100,000. The gain we have in the market, we have to pay to the forward because we lock our risk. No matter happy or not, we will be fixed, in that condition that we have fixed initially. So in this case, you will have to credit cash and you will have to debit forward derivative. But having said that, you will earn that money by selling it in the market because the market price is higher now already, right? So that's how you do it. So the takeaway is no matter what happens, when you have a hedge gain, you must have a hedge loss. So, for example, if your inventory got hedge gain, then your instrument will hedge loss. But sometimes the amount may not be the same. So this kind of story, the fair value hedge, these two examples are very similar. In this case, we have the same amount. Okay, so you might have to do more practices. Now then we will look at example 13. Now example 13, it is, you have to figure out what is this. So some of you actually treat it as a parent question, which is not correct. Now, you can see significant influence, you can see 35%. Okay, so this is an associate question in between 20% to below 50%. And just now we mentioned, associate question, memang easy, you don't have to look at a lot of things. Your consideration is your investment in associate. So at inception, we will use a cost method. Okay, so we are Sul, right? Sul is an investor and Ram is an associate. Okay, in this story. Now, and you go and the information give you like many things lah. So the book value of the investee is 320,000, and then there is one fair value increase, and then the notional goodwill. So what do you think about original entry? Now for this question, you have to think a little bit. There is a notional goodwill. So I just highlight the notional goodwill first, which is 30,000. Notional goodwill means you pay extra, but you don't have to split it out and name it as a goodwill. That's called notional goodwill. Okay, you pay extra. So you pay extra 30,000. So how are we going to calculate backward to see how much we paid for? Now, you see carefully what I do. So it's like this. I enter this first. I think I wrote in another test. Then I draw. Okay, so first of all, right, the net asset 320,000, but it is not the end because we have something revalued upwards. So the 40,000 is the gross amount. So you have to find net of tax. Okay, so I will just enter until here. Now, so our fair value of identifiable net asset is equal to of the associate is equal to how much? It is equal to 320,000 given by the question but not finished because there is a revaluation upwards, right? So the revaluation upwards is 40,000. Okay, so the 40,000 is a revaluation reserve, gross amount, and we have to do net of tax. So the tax rate is given in the question 30%. So we will use 40,000 times 0.7, which is 28,000. So is it important for us to understand the building is 160,000, the useful life is 10 years and all that? No, because at inception it is not important. You're doing the first date only. So you don't need those information. So we sum them up, it is equal to 348,000. 348,000 is the true value of the associate on the date we acquire, which is 1st of January 20x8. 1st of January 20x8, the true value of this associate is 348,000, but we are only acquiring 35%, as mentioned just now up there. So we are only acquiring 35%, which is equivalent to 121,800. Okay, so you are paying an extra of 30,000, and therefore how much you pay? 151,008. Again. Now we are acquiring 35% shares in this company, and the true value of the company on the day we acquire is 348,000. That means we are acquiring 121,800. However, we are paying extra. We think that it worth our money lah. So this value, this 35% worth to our company, we pay extra 30,000. So how much we pay? To pay 151,008 lah. So are we going to write with debit goodwill 30,000? No. The 151,008 straight away, we will just write it as investment in associate 151.8, and then we credit bank 151.8 like that. So this is what we will do. So cost method at inception is investable, not in the one line consolidation yet using the equity method. So maybe for future use I screenshot. What should I do? Then I should. Do you have any questions first? Okay, then we will move on to question 14. Question 14 onwards is 44. So this one is supposed to be. Module 4 I use class teaching notes. I think some of you have not finished study. You don't know what's the meaning of that place. Do I show you before the text computation prima facie, and blah 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 like that. And this type. Okay, never mind, we'll do it now. From question 14, they are all module 4 questions. Okay, and you will find that there are many questions asking about a template because template based, right? Template reconciling item disclosure. But I actually want you to do everything so it's my fault. So for those who answer the tax expense, it is considered as correct, but actually I want you to do everything from prima facie until current tax expense. Okay, so basically when you see a reconciliation, now it's like this. You don't do like accounting one column, tax one column, and everything multiplied 30%, bank sum. It's not like that. So we only have these few things. Okay, this one is the one after multiplying 30% tax rate, which is the tax effect. So you have to understand one thing now. Listen carefully. Number one, accounting profit is from the statement of profit or loss. Accounting profit is from the statement of profit or loss, which is profit before tax, that one. Okay, that's called accounting profit. The one you prepare your account, sales minus what, then gross profit, then minus expense, then you have profit before tax, that's accounting profit. If you use this accounting profit times 30% tax rate, you name it as a prima facie tax. Okay, then after that you will do two big group of adjustment. The first group is non-temporally different adjustment. So if you have non-temporary different adjustment, meaning forever, it's like this. It is not, the difference is not temporarily, forever is like that. In this country, penalty, you cannot deduct tax because it's on fault. Entertainment, maybe you have to add back a bit or whatever. So it is not a DTA, it's not a DTL. That's called non-temporarily different adjustment. If you have all these adjustments, you adjust already, and then you got one answer here, gross amount. If you multiply 30%, you will name it as tax expense. Yang two tax expense is actually the one appear most of the time unless you have foreign tax income. This is the one will appear in your income statement after profit before tax as tax expense. That's the tax expense. And then after that you will get your profit for the year of profit after tax. This is actually the one. Okay? Now, then we might adjust for non-temporarily different movement, the one that you have DTA, DTL, the one. So you have to split into two components. You cannot mix everything up because you cannot find the correct answer from prima facie to current tax. So after you have done all your temporary different movement, so the answer for your temporary difference, times 30%. If your answer is a negative means it is an expense, if you can remember in such a way. If positive, that means it is an income. So when you have a negative, this temporary different answer is times 30%, you will get different tax expense. Okay? Then after that you got your total, right? This one is total, then you minus this, then you get your final total. Final total is taxable profit. Taxable profit will always lead to current tax expense. That's the amount that we have to pay to the tax authority. So if you multiply 30% tax rate, that's your current tax expense answer already. So you can play around with the number, you plus here, plus there, right? Except for the very complex one, like one of the questions we have tax loss, that one maybe you cannot tie it that in such a way. Otherwise, you can tie like this. Tax expense is equal to deferred tax expense. You've got deferred tax income that you minus out yourself. And then plus current tax expense. If you have current tax income, you have to minus it out. So you can try out. Our deferred tax expense here in this story is 300 0.3k is 300 and then in this case we have current tax expense which is 30,600. So 300 plus 30,600 is 30,900. So you can actually tie back even the numbers. So you don't use everything to multiply 30%, not. So you will do like this. Okay. Do you have any question?
So this answer can stop at tax expense or current tax expense?
Okay. Now the question from your module quiz asks you to do up to here. Actually, my intention is ask you to do everything, but I forgot to type one more current in front. So if you do up to here, then you will get full marks. But not many people, I think maybe one or two. So I felt like even I forgot to type also never mind because it's like at first I thought, oh, I forgot to type, but after that once I really fucking to Pengsan already, I felt like, oh, okay, it is not a very major movement. So, yeah. So the marks is like marked very roughly lah. Very, very roughly. So,
Negatif 1 ni daripada
if you look at the question and see the answer.
Ha?
daripada mana?
Tax depreciation. Accumulated tax depreciation.
Nobody comment. Okay. So, let's look at this answer and tie it back. Now, our accounting profit before tax 100,000, copy paste over there. Now, which are the non-temporary different movements? Sometimes you have the absolute question to give you a lot of story and ask you, please choose the non-temporary different movement, or please choose the temporary different movement. Then you have to know lah which one and which one. So normally our non-temporary different movement cannot run away. Always do the same. Penalty, entertainment, basic goodwill, impairment, expense, okay? So these are the few possibilities. So the fine is 1,000, you copy paste. Now entertainment expenses is a bit tricky. It is 2,500, 20% deductible. In Malaysia, we will normally say 50%. But then if you're looking at one by one, you entertain the existing customer, you can have full deduction. A potential customer, no deduction, and so on and so forth. And sometimes we put a shortcut 50% of that. So in this case, you just follow lah. If 20% is deductible, how many percent is not deductible? 80%. That means 80%, right? You have to increase the profit to pay more tax. That's the meaning. So 80% not deductible means your expenses 80%. You have to increase the taxable profit. You have to pay more tax because the government in this country say cannot. So 2,500 you have to multiply by 80%. So the 80%, which is $2,000 eventually, you will increase your accounting profit to a higher taxable profit. You have to pay more tax. And this is not a temporary different movement. Forever is like that. In this country, it is always like that. So penalty 100% cannot deduct deduction. So you have to increase your taxable profit to pay more tax. So eventually, 3,000 is our total non-temporary different adjustment. 3,000 plus 100,000 is 103,000 times 30% is our tax expense. So this is a template question. Okay, then our temporary difference. You know this is the movement, right? Because you are calculating this in the income statement, it is the movement. So if you have a carry down, you have to minus the brought down. So this is the movement. So why this is the answer? Because this is also the movement. Every year our accounting depreciation is 5,000. Every year our tax depreciation is 6,000. Okay, shortcut. Now, if you have no time to remember so many things. Depreciation very common. We have a taxable temporary difference, and it is going to happen when we have accelerated tax depreciation. That means the tax depreciates faster, more, whatever. Bigger. The amount is bigger. I also can. So the tax depreciation is faster, more, okay, than the accounting depreciation. So the difference, right, you will actually take it as a TTD, and therefore you have a DTL. So if your accounting depreciation is slow, 5,000 slow, right, 6,000 fast, right? So there is a 1,000 difference. So your difference is 1,000, and we name it as taxable temporary difference, 1,000. And we know that TTD will lead to a DTL. So at initial stage, we will credit DTL and we will debit deferred tax expense, right? And therefore, it is an expense. It is an expense you will minus because you will reduce your accounting profit to a lower taxable profit, so you will minus. You can think in such a way or other way to help you to understand it better. So for this is the difference of 5,000 accounting depreciation and 6,000 tax depreciation, and it is a taxable temporarily different, which will lead to a deferred tax expense. So it is a minus here. You have to reduce your profit, so it is a minus here. So you multiply by 30% tax rate, you are actually getting the movement. You will debit deferred tax expense the 300, you will credit DTL 300. Okay. Then you sum them up is your taxable profit 102,000 times 30%, you will get current tax expense 30,600. This is the amount you have to pay to government. Okay. This is the amount you have to pay along. So you will debit current, if this is a general entry question, you will debit current tax expense 30,600, and then you will credit current tax liability. It is also known as provision for taxation. It is also known as tax payable. Okay, so you will credit like that. So this is your journal entry if you are required to do that, but you are not required to do that in this question. Just a technical question. And then the next question is about revaluation. Almost ready, Now, on 1st of January 2001, we purchased a tractor 500,000, depreciated 10 years. So you know your accounting depreciation is 50,000 in the first place. So I know, I write here also, my accounting depreciation is 50K. And then my tax is 15%. So you use, question 15, right? So you use 500,000 times 15%. Then I know my tax depreciation is 75,000. Okay, which one is faster? So we know there is an accelerated means faster. Accelerated tax depreciation, and we know eventually we have a TTL. There is a TTD. The difference is the TTD. Okay. However, unfortunately, this is not the story. The story is more difficult. So on 31st of December X5, we want to use revaluation model, and the capital gain tax cost base is 520,000. The given space is because capital gain tax is applicable. And then on 31st of December, the fair X5, the fair value of the tractor is 600,000. So what are we supposed to do? Now, you break this question to two. For elementary level, for those of you who are just studying module 4, then you try to think about this slowly first. Then you can understand, then later on, next time you understand about that. That one is part C. This one is the normal one. This one is the basic one you must know. Even you sleep also, you have to understand how to do this in your dream. Okay, so what I did here was like this. Okay, you look at this like that first. So our accounting depreciation is 50,000, tax depreciation is 75,000, and then full 5 years, right? Because we bought it on 1st of January X1. So X1 1 year, X2 second year, X3, X4, X5. So 5 years. So full 5 years, our accumulated depreciation will be equal to how much? This one times 5 years, right? Your accumulated depreciation will be equal to this one times 5 years, which is 250,000. So the cost 500,000 minus 250,000 accumulated depreciation, it is equal to carrying amount 250,000 from accounting perspective. Now, and then our tax base is how much? Now, our tax base is equal to 500,000 times 75,000 tax depreciation every year times 5 years. I'm looking at the first paragraph for the elementary level. Okay, so at least you must know how to do this first. That means I'm looking at the first paragraph, not yet the second paragraph, not yet the revaluation one. Okay, so so our tax base, from the tax perspective, it is the cost 500,000 minus don't know how much is this, minus the accumulated tax depreciation. You will be able to get a tax base of 125,000. So the basic you have to know. If this is a property, plant and equipment to use, then the carrying amount is bigger than the tax base by 125,000. It is an asset. Your formula say this is a TTD. This is a taxable temporary deferred. But just like I told you already, accelerated tax depreciation will lead to a TTD. Just like I told you already. It has to be a PTL. Okay, it has to be a PTL. So 125 times 30% is equal to BTL carry down 37,500. This is another technique. Okay, this one is for those who are on track and you are a bit like, you know, like some shortcut already. This one you can think. The rest don't have to think about it. Now, for those who are like on track already, right, you should know. Once you see, you know already. So let's see. My accounting depreciation 50, my tax depreciation 75, accelerated by 25. So every year, right, I have 25,000 times 30% as my deferred tax expense and BTL journal entry or movement. Yeah. So you can actually do like this. 25,000 times 5 years, you will get the answer as well. 25,000 times 5 years times 30%, you will get the answer as well. Because 25,000 is the taxable temporary difference. You have to multiply by 30%. Those who cannot understand, forget about it. Until here, you will get an answer. Like that, compare, then you will get an answer. Okay, however, this question is not that simple. This question is that you will have to think about revaluation. So now on 31st of December X5, we want to use revaluation already. Then our fair value is 600,000. So the first thing you know that you learned in module 1 or module 2, I forgot already. Our fair value is 600,000. When you want to use a revaluation model, what are you supposed to do? Your carrying amount, you should increase, you should adjust to 600,000. This is the first thing that you need to know. The carrying amount, 250,000, has to be adjusted to 600,000 because you are using a revaluation model now at this point, paragraph 2. So, pause for a while. I'm not going to demonstrate to you the journal entry for revaluation. You can study on your own. I'll show you the answer here. So, what you can see from my demo here, right, is like this. Okay. When we do revaluation, our carrying amount 250,000, we have to increase to the fair value of 600,000 by 350,000. By 350,000, you have to see. So eventually your carrying amount is equal to how much? Your carrying amount is equal to 250 or 600 or 350? Huh? 600 huh? 600 lah. You have to increase your carrying amount to the fair value 600,000 because you revalue upwards to 600,000. Because the question actually asks you, right? Ask you about what? Compute the carrying amount, right? If we want to change, we want to recover through sale, your adjusted carrying amount will be equal to 600,000. And then how much is our tax base? You have to calculate like that. Now you have adjusted your carrying amount to 600,000. Maybe I just type this all in. Okay, so it's like this. Cost is we bought it at 500, and then our accumulated depreciation is 250, and therefore our carrying amount is 250 lah. This minus that, right? Okay, so now we want to adjust our carrying amount from 250 to 600. So normally we will use the method to zeroize accumulated depreciation. We will normally zeroize it. So how are you going to zeroize it? You will debit out the accumulated depreciation 250 to make it to 0. So you zeroize it already, it becomes 0 lah. Okay, this one becomes 0. So what are you going to do to the 500 to make it to 600? You have to increase off. I have to debit the cost of the tractor lah. Cost of the tractor, or I debit tractor lah, tractor cost, whatever. So it is 100. So when I increase by 100, 500 plus 100 is equal to 600. So this 250 normal balance credit side minus the one I debit now, 250 is 0. So 600 minus 600, is it 600? So I have adjusted my carrying amount to the fair value by doing this. Okay, so what am I supposed to credit? So I'm supposed to credit revaluation reserve. Can I do 0.7? Cannot. When you have PPE through sale, unfortunately, the DTL not so easy already. Cannot do like 30% of that whole thing. Cannot already. That's why I have no choice. I will have to do slowly. This one is okay. I will have to do slowly. How am I going to do slowly? I do like that first. I credit my revaluation reserve gross amount. Then later on only I calculate my DTL by using the formula. What formula I remember now? When we have an asset, tax base is equal to carrying amount plus future deductible amount minus future taxable amount. When it is through sale, you have no choice. You have to use the formula. Okay, formula you also have to be careful. Now our carrying amount is equal to how much already? Carrying amount has been adjusted to equal to the fair value, which is 600. So our tax base is equal to carrying amount 600,000 plus future deductible amount. It requires a bit of功夫already. Now, your future deductible amount, how are you going to calculate how much tax deduction you still can claim in future? It is equal to the capital gain tax cost base given by the question minus all the tax depreciation that you have depreciated in the past. The leftover will be the future tax deduction. So in the question, our capital gain tax cost base is 520. So you no longer use 500,000 already. You no longer use the cost 500,000 you bought already. So you will use capital gain tax cost base if capital gain tax is applicable. Then you have to use this. So 520,000 minus the tax depreciation that you have depreciated throughout the 5 years. So this one times 5 years is, I don't know how much. So you will use 520,000 minus 75,000 times 5 years that amount as your future deductible amount. In future, you still have some leftover to pay for the tax deduction, which is blah 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 amount. And then future taxable amount is the same as carrying amount. Okay? If it is through sales with capital gain tax cost base. If it is not with capital gain tax cost, then you will have a different calculation. You study it. So this one minus 600, cut no more already. So 520 minus 75 times 5 is equal to how much? It is equal to 145 today. 145. And this is our tax base. So you use this tax base to compare with this carrying amount. You see our carrying amount becomes 600. So our carrying amount 600 is larger than the tax base 145 by 455 by this amount. So this amount is the taxable temporary deferred. Then you use this amount times 30%, you will get DTL carried out. But it is not your answer for your journal entry. Because just now, right, you have this DTL carried down 37,005, which is your brought forward amount. So the difference is your answer. This one minus this one, I think it's 99,000. This one minus this one is your answer. This one minus this one, the movement. This one minus this one, the movement is 99,000. So this 99,000 is the tax effect, not 30% of the whole thing, that you will reverse from revaluation reserve to get the revaluation reserve net of tax, which is much more difficult in that case. So our full answer is this. Full answer. This is our full answer. So if you want to expand a little bit, then you just think like RR net of tax is equal to how much? Okay. So our basically you will know that our cost carried out is 500. Accumulated depreciation is 0. Cost carried out is not 500, it is 600, right? Yeah. increased 100 already. It is, maybe I do that 500 plus 100 equal to 600. Accumulated depreciation is equal to 250 minus 250 equal to 0. DTL carried out is equal to 37.5 and 37.5 plus 99 equal to 136.5. And then RR net of tax carried out is equal to 350 minus 99. Hopefully you don't have this type of question, but you don't know, right? Yeah. So do your best. Okay. What question is it? 15. 15. Okay, last already. I will do a wrap up soon. I really lost all my energy. Okay, then okay, so question 16, I want you, because I think it's very clear, I have guided you what to do and so on, right? So I want you to think slowly on your own. Remember this question, a lot of students write everything multiply 30% until I don't know what to do. So question 4.6 is the one that you can look at, the low sale case is the one that you can actually look at when you try to do this kind of question. So basically this is the answer. Oh, this I will not let you do your own. This is 17 or 16. 17, right? Yeah, that's right. 17, I must go through it. The tax loss, this one is the normal one, right? 16. Yeah, this is the normal one. Anyway, okay. So you will try to use the same method to prepare the answer for question 16, since it should be the same. And I want to stress on question okay, good part. I mix up, maybe my hard copy is different. Okay, I would like to talk about this question with all of you, one shot. Okay, now, so let's look at this question. We have an accounting loss because it is a bracket, 4,005. Now, and then every year, this one is every year. Now, just like I told you, when tax depreciation exceeds the accounting depreciation, there is accelerated tax depreciation. Are you going to have a DTD or TTD when tax depreciate faster? TTD lah, there will be a DTL, so there will be a TTD. And we have one table saying that when you have a tax loss, the tax loss is considered as a deductible temporary difference. So this deductible temporary difference of tax loss, which is 4,005, you have to think whether I can recognize times 30% become DTA or not. So the first thing you think is whether you have TTD or not. If you have TTD, that amount, you can actually recognize the DTA based on that. So now we know we have $500 taxable temporarily different. Okay, and we can use it for like 10 years. But we are not able to confirm whether we are going to have future taxable profit. It is not probable that we have a future taxable profit, and therefore you cannot recognize the whole thing times 30% as your DTA. However, you can recognize up to 500 times 30%. So what are we gonna do is you will see it over here. Okay, now can you see this or not? We have accounting loss 4,005. We have accelerated tax depreciation 500. So by right, we have a taxable loss of 5,000. Okay. So this taxable loss, you can actually recoup in future. You can utilize in future. But from here we know we have a 500 times 30% of DTL. So we have a 500 accelerated tax depreciation, which is our taxable temporary difference, which is the movement as well during the year. So for this movement, you multiply by 30%, you will get DTL 150, and you will debit deferred tax expense 150. Sorry, I'm here. This is and we are assuming this is the one that we're going to do. I do a competition. We are here X1 only. Sorry, we are not X2. We are X1. Now, and because we have 500 TDD, and therefore you can recognize 500 DTD as DTA from tax loss. And you will see that your DTA and DTL is the same. Now you can look at the more challenging question recording in module 4. So, however, I combine this, you can separate it out if it is not so confused, sorry. So now, this is one pair. You debit DTA and you will credit current tax income. You don't credit deferred tax income. Why? When you credit current tax income, it means that this DTA comes from a taxable loss. Once you see current tax income, you know that you got taxable loss. But never mind, this taxable loss will be recouped, will be utilized in future. Now, so how much unrecognized taxable loss we have? 4,005. So we have 4,005 to be remembered but not recognized yet. So the story is a happy story, I guess, because in the second year we have a taxable profit of 7,000. So are we going to pay, because I told you, a general rule of thumb, you will use taxable profit times 30% to find your current tax expense, right? That's the amount you have to pay to the government, right? So you use 7,000 times 30% is 2,100, right? But when you combine the whole thing, this is a special case, it's not general rule of thumb. Because last time you make taxable loss, you don't have to pay 2,001 that much. You can utilize the unutilized loss before. So 7,000, oh yeah, I want to change this. Sorry, I forgot to change this. Can you please change for me? I want to change this a bit. I want to write that there is an accounting profit of 7,000 so that you have a bit of things to do. So we have accounting profit of 7,000, and don't forget we have accelerated tax depreciation of 500, and therefore our taxable profit is 6,005. But you don't have to pay for it because you have to utilize the unutilized tax loss in the previous year, and you pay the remaining balance only based on 1,005. So what are we supposed to do? The 500 TDD, you have to recognize it as DTL as usual, the one I saw just now, wrongly. That one is for X2 second year. So you do this one is like no challenge as usual. And then after that, why do we have to recognize the DTA from last year? Last year you got this DTA, which is brought down this year. I will credit out because this DTA comes from taxable loss. I utilize the whole thing this year, so I have to credit it out. I have to recognize it. So I credit this out. When I credit out, then never mind already. I will just debit the normal thing called deferred tax expense, like the recoupment of prior year taxable loss. In Malaysia, we like to say this is a utilization of unutilized loss or unabsorbed loss in prior year. Now, after that, why do I do this? Because I will now recognize the unrecognized taxable loss last year, because I think that I cannot make a profit, right? It's not probable, right? So the unrecognized deductible temporary difference is 4,005, right? Times 30% is 1,350. So when we do this, you see the table, you know already. If it's not probable, it is probable, what are we going to do? So you will, I think one student did longer way, that one okay, can. So you can debit DTA, credit current tax income, and then after that you debit deferred tax expense, credit DTA, cut also can. So eventually you will get this answer. Okay, this is your answer, 1,350. And then the last one that we don't miss out is the amount we have to pay. So after minus out everything, right, how much we are supposed to pay? supposed to pay 1,500 only. I mean based on, not paid, sorry. Based on 1,500 only. So this 1,500 net taxable profit multiplied by 30% tax rate, you will actually get 4,500 current tax expense, and every time, like what I told you just now, every time you will debit current tax expense and credit current tax deductible. Like that. Okay, so I do like the whole thing lah. So your tax expense will be equal to how much? You do a calculation yourself, and then you take a picture, and then your DTA is equal to how much? No more, because no more unutilized taxable profit, taxable loss. No more unutilized taxable loss. So your DTR is equal to how much? 300. Why? It is because of the tax depreciation is faster than the profit depreciation, not because of the taxable loss. So we will just continue the stock. Okay. Now, for the other two questions, I would like you to think slowly on your own, and I hope that you can. You see this question, sorry, this I confused myself maybe. So question 70, you can take picture of this answer because I might reduce it next time. So you use the same method like question 14 like that. Left hand side you start from accounting profit. Then after that you adjust for the non-temporary different movement. Then after that you adjust for the temporary different movement. And then after that you get your taxable profit. So on the right hand side, only that few things you multiply 30% to get your prima facie, tax expense, deferred tax expense or income, and current tax expense. So for question 18, you are required to prepare a journal entries as well. Okay. So question 18, you have to do a template, and also followed by journal entries, right? So I show you the answer now. Many of you got correct. This is actually one of the questions I think we did in part 4 or something like that. I just reduced the question. So that's the question I thought, yeah, maybe I can take it as your marks, but cannot argue. So yeah, so this question, right, the answer is like this. It is quite straightforward. You just have to make sure you know whether it is an asset or liability. Then you use the tax-based formula to calculate since it is correct. Then you take a different. Then you have to write whether this is taxable temporary different or deductible temporary different. How much? How much is the difference? The difference is how much? And how did I mark this time is like this. If you answer the whole row correctly, 2 marks. If you answer at least one correctly, 1 mark. So altogether is 10 marks. And then if you answer the journal entries correctly, is 3 marks. Some of you write 1 by 1 until some also 10 or something like that. So roughly if you correct like about there, then I'll give you 1.5 marks for that. If it's correctly there, I'll give you 1.5 marks. So this is the and we did this question before. Alright. So are you more confident now? Oh sorry, which one you want to take? Okay. Later I will send you the recording, and from recording you can also see. Then after the semester end I will hide back the recording. So are you better now? Okay now? Hopefully if not later my heart broken already. Yeah, and so about the practice exam, we will do next Thursday, 9 o'clock until 12 o'clock. If you are late or whatever, right, we will stop at 12 o'clock, okay? And then 1:30, we will start to discuss the question. And we will take this as a revision. Because I look back at my internal exam question, I felt like more or less lah. So, okay, the last bit. Your final exam, 42 multiple choice question. I just follow the same like last time, like your external exam. So that will be 42 marks. And then extended question, 4 questions equal to 18 marks. Module 3, Module 7, Module 5, and Module 4. What should I say that? Module 3, Module 4, Module 5, 3 to 5 and 7. 3, 4, 5, 7, 4 questions. 18 marks. No breakdown already. So I feel it's more or less like the difficulties. That's why I asked you to do practice exam 1, we take it as a revision. And just now I simply scroll around and I saw this, the Masale, I think caught me, right? He said if you do not know what to do, you are off track and also on. If you have not started studying, probably not, then he actually give you a 10 days plan to tell you what you should do. 10 days finish everything. So you see where are you up to lah. If you are not following so far, which is quite disappointing, then maybe you can consider doing this like 10 days. But if you have already started, then you can quickly complete the unfinished one, I think it will be okay. Alright? So I will stop here. I will see you again next Thursday all